Public.com presents The Rundown, your daily market update in 10 minutes. My name is Zaid Admani, and today is Thursday, July 23rd. In today's episode, we'll tell you why oil prices and bond yields are surging and what it means for the Fed's big decision next week. We'll also recap earnings from Google and Tesla and explain why investors are getting nervous despite decent results. Then stick around to the end of the show to find out why investors need to pay attention to the Japanese yen. We got a great show for you today. Let's go. Stocks basically went nowhere on Wednesday. The S&P 500 fell 0.1%, while the Nasdaq dropped about 0.5%. Trading volumes were pretty light yesterday. I think everyone was waiting for Google and Tesla to drop earnings after the bell. We got those numbers, and we'll break them down in a bit. Now, despite the stock market being relatively quiet, there was a ton of action happening in the oil and bond market. Oil prices keep climbing. Brent crude is now approaching $100 a barrel, which is $25 more than it was earlier this month. The market is starting to take the escalation in the Middle East more seriously again. And look, with higher oil prices means a likely resurgence in inflation, which brings me to the bond market. The 30-year Treasury yield has now been above 5% for 12 straight days. That's the longest run above that level since 2007. So we're talking like financial crisis era. What the bond market is signaling right now is that interest rates may need to stay elevated for longer or even go higher. So the bond market is kind of freaking out right now, which is weird because the stock market isn't fazed by any of it. Despite oil prices surging and bond yields being elevated and a Fed hike now expected, the S&P is still near record highs right now. So one of these markets is wrong, and historically, the bond market tends to be more accurate. We're gonna continue to keep an eye on the bond market along with everything else happening, so definitely get subscribed to the podcast if you haven't already, and tune in every day to stay in the loop. Let's run through some headlines. And we're talking earnings from Google and Tesla. Let's start with Google first. Google reported earnings last night, and honestly, the quarter itself was very strong. But the stock is still dropping today because investors are concerned on all the money that Google is spending on AI. Let's start with the good stuff first because there's a lot to talk about here. Revenues in Q2 came in at nearly $120 billion, which was up 24% from a year ago and ahead of Wall Street estimates. The star of the show was Google's cloud business. Cloud revenue jumped 82% to almost $25 billion. Wall Street was expecting 63% growth, so this was a blowout performance. And then to add to that, their backlog, which is contracted cloud business that Google hasn't collected on yet, grew to $514 billion. And Google says that more than half of that will convert to revenue in the next 2 years. So what that tells me is that there's clearly a ton of demand for all the AI infrastructure that Google is building out. Beyond just cloud, their search business continues to hold up surprisingly well despite all the predictions that ChatGPT was going to kill Google. Search revenue grew 17% to more than $63 billion. Now, to be fair, that did miss Wall Street estimates by less than 1%, but that could just be currency related. So overall, Google had a monster quarter, but their stock is still down around 4% in pre-market trading. And I think the main reason for that is that Google's free cash flow last quarter came in at negative $5.9 billion. Google has literally never had a negative free cash flow quarter in their 2 decades as a public company. But the company continues to burn a ton of cash on AI infrastructure. They spent almost $45 billion on CapEx last quarter. Most of that money went towards data centers, chips, and other AI-related expenses. And I think that was the key takeaway from these earnings. Google isn't backing off on CapEx spending. In fact, they raised their spending forecast again. They now expect to spend up to $205 billion on CapEx this year, which was up from the previous forecast of $190 billion. The CFO went as far to warn that spending could climb even higher next year and that free cash flow will remain under pressure. So I think that's why the stock is dropping despite their monster quarter. But in this case, I don't really blame Google for not backing off on CapEx spending because they're starting to see the payoff now. Their cloud revenue is accelerating and the backlog is now over $500 billion. So I'm not gonna lie, I was a little surprised to see Google stock fall after these earnings. I think one thing is clear though, Google is not blinking from investor pressure on all their CapEx spending. The pressure is now on Microsoft, Amazon, and Meta on what they do with their CapEx. Are they gonna do the same thing as Google and keep raising their number? And how how is the market going to react to that? All these companies are reporting earnings next week, so we should find out pretty soon. Let's shift gears and talk about Tesla, even though Teslas don't technically have any gears. Tesla also reported earnings last night, and their numbers were a mixed bag. Let's talk about the good stuff first. Tesla is starting to sell more cars again. Tesla delivered over 480,000 cars last quarter, which was up 25% from a year ago. The company's overall revenues jumped 26% to $28.2 billion, which beat Wall Street estimates. So that was a bright spot. After 2 straight years of declining deliveries, Tesla car sales are starting to make a comeback, probably thanks to higher gas prices. Now, when you dig deeper, a lot of that growth came from Europe and China. Sales in the US were actually down roughly 20%. The other notable thing is that Tesla is making less money on each car they sell. Gross margins fell to 16.8%, and operating margin dropped to just 1.4%. Overall profits for the quarter came in at $1.1 billion, which was down 5% from the same quarter last year, and adjusted earnings of 33 cents a share badly missed Wall Street estimates of 51 cents a share. The big takeaway from the earnings was that Tesla is ramping up on CapEx as well. CapEx jumped 142% in Q2 to $5.8 billion, and Tesla plans to spend more than $25 billion on CapEx this year. That money is going to go towards retooling factories for the Cybercab and Optimus robots, and also a chip plant that they're building in Texas called Terafab. The markets didn't love the increased CapEx number. Shares of Tesla are down more than 6% in pre-market trading. And honestly, I'm kind of surprised the stock isn't down even more. There's a difference between Google spending a lot on CapEx and Tesla doing it. Google can already point to their cloud revenue growth as a very obvious payoff from the spending. Tesla, on the other hand, is burning cash on robotaxis and humanoid robots that generate basically $0 in revenue today. So Elon is asking investors to be more patient. And historically, the market has been pretty patient with Elon. Now, another interesting wrinkle to come from these earnings is what Elon said on the earnings call. He was asked whether Tesla and SpaceX could eventually merge, and instead of shutting it down immediately, he basically said that there's more and more overlap between the two companies. So that might have been a wink to the market that he might be combining his two companies in the near future. Let's talk about some stocks making moves today. Shares of ServiceNow were on the rise after the software company reported better than expected sales and bookings. Subscription revenue jumped 25% to $3.88 billion, while near-term bookings grew 21%. Both those metrics came in ahead of Wall Street estimates. ServiceNow makes software that automates workflows across IT, HR, and customer service operations, and they're trying to convince investors that AI isn't going to disrupt their business. In fact, they make the case that AI is going to be a boost for them. Their AI business just crossed $1 billion in annual contract value, and they also renewed 98% of their customers last quarter, so clients don't seem to be going anywhere. As a result, shares of ServiceNow are up around 4% this morning at the time of this recording. But if you zoom out, the stock is still down more than 30% for the year. On the flip side, IBM stock continues to slide after they officially reported the ugly quarter they warned investors about last week. Revenues grew just 1% last quarter to $17.2 billion, missing Wall Street estimates, and adjusted earnings of $2.93 per share also slightly missed estimates. The biggest weakness for the company came from their old school mainframe business. Sales plunged 42% as their customers delayed spending and shifted more of their budgets towards AI infrastructure like servers and memory. And overall, IBM cut their full year revenue forecast. Management says that many of the big deals that didn't happen last quarter were just delayed and not canceled. In fact, they say about a third of those deals have already closed in Q3. But investors don't seem to be convinced. IBM shares are down around 2% this morning at the time of this recording. And if you zoom out, the stock is down roughly 30% on the year. Let's wrap the show with a fun fact. The Japanese yen is now at its weakest level in 40 years. This week, the yen hit 163 yen per dollar, which is a level that we haven't seen since December of 1986. Now, Japan's central bank has been desperately trying to stop the slide of their currency. The government has spent nearly $74 billion buying yen earlier this year, but that really hasn't had much impact. Now, the reason the yen keeps sliding is pretty interesting, and it impacts US investors too. See, Japan's interest rates are still super low compared to the US. loss. So investors borrow money in yen, which is cheap, and they convert that to dollars, and they invest that money into high-yielding investments in the US like stocks and bonds. There's actually a name for this called the yen carry trade. The problem, though, is the money leaving Japan keeps crushing their currency. Now, this could be a problem for US investors because if Japan steps in aggressively and the yen suddenly spikes, well, then traders may have to unwind their positions, sell their stock or bonds to pay back their yen loans. This famously happened not too long ago. Back in September of 2024, the yen rallied and the markets tanked for a couple of days. So that's why US investors need to keep an eye on the yen. Let's hope that history doesn't repeat itself with the yen carry meltdown in 2026. On the bright side, it's a great time for American tourists to visit Japan. In fact, I might have to do a deep dive about the yen carry trade from Tokyo. We gotta convince Mike in the comments to approve that one. Well, all right, guys, that's the rundown for today. Hope you guys enjoyed today's episode. Thank you guys so much for listening, watching, and commenting. Shout out to Mike for all the work behind the scenes. And we'll see you guys back here tomorrow.